Hello, my name's Joseph Graff. Before I get started with the video today, I want to tell you all that this video is just one part of a 500-part series where I analyze the 500 largest companies in America. If you enjoyed today's video, I'll include some links in the description below so you can check out my other stock analysis videos. Also, if you enjoyed today's video, please hit the like button, please subscribe to the channel, and please hit the notification bell so you can be notified when I post future updates. This helps the channel to grow. With that being said, I want to thank you all for watching, and here's the video.
PayPal was founded in 1998 and was originally called Confinity. eBay owned PayPal until 2015. PayPal is a payment processing company that specializes in online payments. PayPal recently acquired iZettle in 2018 for $2.2 billion, and more recently they acquired Honey in early 2020 for $4 billion. PayPal has two main operating segments: transaction revenues and other value-added services. In 2019, their largest segment was their transaction revenues segment, which was responsible for $16.1 billion of the company's revenue for that year. In 2019, transaction revenues was also their fastest growing segment, posting a 17.4% greater revenue in 2019 compared to 2018. PayPal is currently the 19th largest company in America and is valued at $233 billion.
In this next slide, I'm going to show you all the company's earnings per share and earnings growth over the last 5 years. In general, good companies are able to produce positive earnings year in and year out and grow those earnings steadily over time. Large, stable companies such as Coca-Cola tend to produce positive earnings, but they might grow those earnings a little bit slower than a company like Tesla, which may produce negative earnings per share some years, but is generally viewed as having higher growth potential than a stock like Coca-Cola. In general, stocks that post positive earnings year in and year out, like Coca-Cola, tend to be considered less risky investments as compared to stocks like Tesla that may post negative earnings per share some years.
In 2014, PayPal stock earned 34 cents per share. In 2015, this jumped up to $1 per share, which was a growth of 194%. In 2016, they earned 15% more for the year, earning $1.15 per share. In 2017, they earned $1.47 per share, which was a 28% increase year over year. In 2018, they earned $1.71, which was a 16% increase from the previous year. And in 2019, they earned $2.07, which was a 21% increase from 2018. Overall, PayPal has averaged 44% annual growth from 2014 to 2019, which is exceptionally high.
Now that we've taken a look at the company's earnings per share over the past 5 years, we're going to talk a little bit about its price to earnings ratio, also known as PE ratio. PE ratio is simply calculated by taking a company's price per share and dividing it by the company's earnings per share. If you were trying to decide between buying shares in two different companies and everything else was the same, you'd want to buy the company that had the lower price to earnings ratio. This would be because you would be paying less for a company that is earning more per share. In general, companies that have a PE ratio below 20 are considered to be value stocks, while companies with a PE ratio above 20 tend to be growth stocks. In general, stocks with lower PE ratios are companies that investors tend to be a bit more pessimistic about the company's future, whereas stocks with higher PE ratios are companies that investors are a bit more optimistic about the company's future. PE ratio is just one small metric in the tons and tons of metrics that you can use to evaluate companies, but it goes a long way in helping you to get a baseline feel for why the company is valued at what it's valued at.
As of August 10th of 2020, PayPal stock was trading at $193.32 per share. This represents a 12-month trailing price-to-earnings ratio of 88.7. This is one of the highest price-to-earnings ratios I have seen out of all the companies I've analyzed, with only Amazon being higher. To put this into context, the 12-month trailing price to earnings ratio of the Standard & Poor's 500 at the time I recorded this video was 28.9.
As I mentioned earlier, a company's price to earnings ratio is just one metric that you can use to value the company. Another popular metric is a company's price to earnings growth ratio. This is calculated by taking a company's price to earnings ratio and dividing it by the company's growth rate as a percentage. In general, companies with a price to earnings growth ratio of 1 are considered to be fairly valued. Companies with a price to earnings growth ratio above 1 tend to be considered overvalued, and companies with a PEG ratio below 1 tend to be considered as undervalued. Price to earnings growth ratio is a popular metric among investors because it takes both a company's price to earnings ratio and its earnings growth into account. These two metrics are the two main metrics that drive a company's stock price and thus its valuation.
As of August 10th of 2020, PayPal stock was trading at $193.32 per share. This represents a trailing 12-month price to earnings growth ratio of 2.89. Since this value is above 1, it indicates that PayPal may be overvalued if this is the sole metric that you use to evaluate the stock.
In this next slide, we're going to be going over the company's dividend yield, dividend growth rate, and dividend payout ratio. Dividends are popular among many investors because it's a way for investors to see a return on their investment in the form of cash payments. However, keep in mind that when companies decide to pay dividends to investors, that money that is returned to the investors is money that the company cannot use to reinvest into its own company. Dividend growth rate is the rate at which companies grow their dividends year after year. In general, investors like to see a high dividend growth rate as it means that they are receiving more and more money in dividend payments year after year. Dividend payout ratio is the percentage of a company's earnings that they pay out in the form of dividends. In general, companies with a dividend payout ratio below 70% have a good chance of being able to keep paying their dividend into the future and have some potential to grow that dividend in the future as well. Companies with a dividend payout ratio above 90% are generally seen as more risky and have a higher likelihood of cutting their dividend.
PayPal currently does not pay a dividend, as they instead choose to reinvest the money that they earn back into growing their company. It's possible that PayPal may decide to pay out a dividend in the future if their earnings growth slows down. However, for the near future, I don't think PayPal will start paying a dividend because their earnings have been growing very quickly over the past few years, and right now I think it makes a lot more sense for them to continue to reinvest in their company rather than pay out some of those earnings to shareholders.
In this next slide, we'll look at two more metrics that you can use to value a company. The first that we'll look at is price to book ratio. You can calculate a company's book value by simply summing up all of its assets and subtracting its liabilities or debts. You can calculate a company's book value per share by taking its book value and dividing it by the number of outstanding shares. And then you can calculate the company's price to book ratio by taking its price per share and dividing that by its book value per share. Price to book ratio is a good way to get an idea of whether a company is overvalued or undervalued. A company's debt to equity ratio is calculated by summing up all of its debts and dividing that by the total shareholder equity. Debt to equity ratio is a good metric for finding out how much a company uses debt to grow their company. In general, companies with a lower debt to equity ratio will tend to do better during a recession. However, debt is a tool that companies can use to grow their company faster than they would if they did not have any debt. So debt is not necessarily a bad thing.
As of June of 2020, PayPal's book value per share was $15.04. This represents a price to book ratio of 12.9. As of April of 2020, their debt to equity ratio was about 0.5. This is pretty average out of all the companies that I've looked at so far.
In this next slide, we'll take a look at how the company's stock price has changed over the past 3 years, 5 years, and 10 years. Keep in mind that a company's past performance does not guarantee its future performance. However, seeing that a company has done well over the past couple years is usually a good sign and can indicate that the company may continue along that path in future years.
If you would have bought PayPal stock 3 years ago, you would have seen an average annual return of 50%, which is amazing. If you had bought it 5 years ago, you would have seen an average annual return of 38%, which is still fantastic. Normally, I also include a 10-year average annual return, but PayPal stock has not been in existence for 10 years, so I could not include this metric on that slide.
In this next slide, I'm going to give you all my grades for this stock. The first grade that I will give you is what I grade this stock as a defensive investment. This grade is simply a grade that I give based on how well I think a company would do during a recession, as well as how confident I am that the company will continue to generate the same or greater earnings over the next couple years. The next grade that I will give is a growth grade. This grade indicates how I feel about the company's growth potential over the next 5 to 10 years. The third grade that I will give is the company's value at its current price. I'll take a look at what the company's price is at the time I recorded this video and give you all my opinion on whether I think it is undervalued or overvalued. The last grade that I will give you is an overall grade. This is a grade that looks at this company as a long-term investment. This grade indicates how comfortable I would be with holding this company for 10 to 20 years.
As a defensive investment, I gave PayPal a B. I think the world will continue to make online purchases over the next few years, and I think PayPal has positioned themselves well to be used as a processor for those online payments. I think because of the pandemic, online purchases will continue to be strong for years and years into the future, which is why I gave PayPal a pretty good defensive grade of a B. As a growth investment, however, I decided to give them an A-. I think PayPal has a lot of great growth opportunities over the next few years, and I really love payment processing companies. However, for PayPal's value at their current price, I gave them a C+. While I do really like PayPal, and I think they have a great business model and a great company overall, the PE ratio is 88, which is astronomically high. I just don't think PayPal can really support a valuation like that. As an overall investment, I gave PayPal stock a B. I think it might be a bit overvalued right now, but I think it's a very high quality company, and some people might be able to justify the premium that you'd be paying to own a stock like PayPal. So I gave it a B. I think it is a good company, and I think you probably would not regret it if you bought it and held it for 10 years.